Deutsche Bank warns of a global time bomb. Are the 70s coming back? Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of Heise Says. Grab your stein of coffee. We're going to have a look at an article from CNBC discussing a warning from Deutsche Bank of a time bomb, a global time bomb due to rising inflation. Now, they harken back that this will be similar to what was seen in the 70s, back in the 70s, and that made me instantly think of one muscle-bound politician and action hero who made his fortune, or was already a millionaire in the 70s in property due to, well, the high inflation back then. And I thought that was an interesting lesson that we can have a look at. But before we go through this article and before we learn from good old Schwarzenegger, let's have a look at global inflation rates. Now, these are the highest levels of inflation that are currently available. So if you went to Venezuela, the inflation rate is 2,941%. I mean, that is just a complete and utter joke. Okay? If anyone thinks socialism is a good thing, there you go. Every proletarian worker has just lost thousands of percent of the purchasing power of every dollar they've ever worked for. Isn't it awesome, comrade? Then you've got Sudan, Zimbabwe, all the usual countries here with ludicrously high inflation rates. But let's have a look at the lowest inflation rates we have at the moment. So this could be why. Maybe crypto, even with its huge fluctuations of like 20 to 40% or 20% a day, is nothing compared to the 2,941% inflation you get in Venezuela. Maybe that's why some of these countries are starting to adopt it, because it's more stable in their own currency. So in Japan, you've actually got deflation, negative 0.4%. Switzerland, 0.6%. Australia, we're at 1.1%. You've got the UK at 1.5%, Germany 2.5%, and Canada 3.4%, and the US at 4.2%. Now, these are the G20 countries with the lowest rate of inflation. So the concern is more and more that we're going to see inflation ticking up. You've got Yellen, you've got Powell saying it's just transitory. It's due to trade issues. It's due to supply issues. Don't worry about it. It'll be fine. But then you've got people who are complaining about filling up their gas, the petrol at the car. This is the US inflation rate. You can see in the 70s, look at it, how high it spiked. At one point it's up to 15%, guys, almost. So all over the place. And they had to fight hard to get rid of it. So we've had a long period of just decreasing inflation. You even had some deflation back there. So let's have a look at this ticking time bomb, everyone. So Deutsche Bank, that should be a warning sign right there, shouldn't it? Warns of a global time bomb coming due to rising inflation. Inflation may look like a problem that will go away, but is more likely to persist and lead to a crisis in the years ahead, according to a warning from Deutsche Bank economists. In a forecast that is well outside the consensus from policymakers on Wall Street, Deutsche issued a dire warning that focused on stimulus while diminishing inflation fears will prove to be a mistake, if not in the near term, then in 2023 and beyond. If we're focusing too much on the stimulus, don't worry about inflation, guys. Don't worry about it. It'll all be good. Famous last words, perhaps? The analysis especially points the finger at the Federal Reserve and its new framework in which it will tolerate higher inflation for the sake of a full and inclusive recovery. The firm contends that the Fed's intention not to tighten policy until inflation shows a sustained rise will have dire impacts. The consequence of delay will be greater disruption of economic and financial activity that would be otherwise be the case of what the Fed had done. Does finally act. Deutsche's chief economist, David Volkerts-Landauer, and others wrote. In turn, this could create a significant recession and set off a chain of financial distress around the world, particularly in emerging markets. As part of its approach to inflation, the Fed won't raise interest rates or curtail its asset purchase program until it sees substantial further progress towards its inclusive goals. multiple central bank officials have said they are not near those objectives. Now, this is the inclusive goals. You know, all the SJW rubbish that's emerging in the States and throughout the whole world and throughout business. Now, the problem is, who do you think has done the greatest damage to the minorities over in America? Who do you think's been the worst culprit who's stolen more opportunities from them than anyone else? It's the Fed, guys. The Fed. The poor are copying it, you know? They're copying it, guys. In the meantime, indicators such as the consumer price and personal consumption expenditure price indices are well above the Fed's 2% inflation goal. Policymakers say the current rise in inflation is temporary and will abate once supply disruptions and base effects from the early months of the coronavirus pandemic wear off. The Deutsche team disagrees, saying that aggressive stimulus and fundamental economic changes will present inflation ahead that the Fed will be ill-prepared to address. It may take a year longer than 2023, but inflation will re-emerge. And while it is admirable that this patience is due to the fact that the Fed's priorities are shifting towards social goals, neglecting inflation levels, global economies are sitting on a time bomb. The effects could be devastating, particularly for the most vulnerable in society. I mean, here's the thing. You know, you've got this social justice rubbish, social goals. The best thing to improve social goals is to stop manipulating the market, everyone. To stop destroying people's purchasing power. Do you think all the people who were so happy in Venezuela that private property was seized are now happy that they have to eat their pets, or that the purchasing power of their money is completely in the gutter? I'm sure, you know, but don't worry. It's not real socialism, guys. It's not real socialism this time. I'll just wait for those comments to appear. Don't worry. Every one of those comments helps the algorithm, guys. YouTube loves it. It's all interaction. Every one of them. So, most of the street see tame inflation. To be sure, the Deutsche position is not widely held by economists. Most on Wall Street agree with the Fed's view that current inflation pressures are transitory, and they doubt there will be any policy changes soon. Jans Hutzius, chief economist of Goldman Sachs, said there are strong reasons to support the position. One he cites is the likelihood that the expiration of enhanced unemployment benefits will send workers back to their jobs in the coming months, easing wage pressures. Well, see, this is the thing. Once you get a pay rise, you can't really reduce pay, can you? We'll see if that actually manifests to reduce wage pressures, everyone. We'll see, because this is the thing. You know, once it starts creeping up, it's hard to push down. On price pressures in general, he said, that much of current spike is driven by unprecedented roll of outliers that will ebb and bring levels back closer to normal. All this suggests that the Fed's officials can stick with their plans to exit only very gradually from the easy currency policy stance, he wrote. That will be a mistake, according to the Deutsche view. Congress has approved more than $5 trillion in pandemic-related stimulus so far, and the Fed has nearly doubled its balance sheet through monthly asset purchases to just shy of $8 trillion. Sorry, $8 trillion. The stimulus continues to come through even with an economy that is expected to grow at about 10% pace in the second quarter and an employment picture that has added an average of 478,000 jobs a month in 2021. Never before have we seen such coordinated expansionary fiscal and monetary policy. This will continue as output moves above potential, Volker's Lander said. This is why this time is different for inflation. The Deutsche team said the coming inflation could resemble the 1970's experience, a decade during which inflation averaged nearly 7% and was well into double digits at various times. Soaring food prices and energy prices, along with the end of price controls, helped push the era's soaring inflation. Then Fed Chairman Paul Volcker led the effort to squash inflation then, but needed to use dramatic interest rate hikes that triggered a recession. The Deutsche team worries that such a scenario could play out again. Already, many sources of rising prices are filtering through into the US economy. Even if they are transitory on paper, they may feed into expectations just as they did in the 70s, they said. The risk then is that even if they are only embedded for a few months, they may be difficult to contain, especially with stimulus so high. The firm said interest rate hikes could cause havoc in a debt-heavy world, with financial crises likely, particularly in emerging economies where growth won't be able to overcome higher financing costs. So, there you go. Some interesting perspectives. Deutsche Bank going against the street, predicting, well, dangerously and frustratingly high inflations. So what can we learn? Before I put some solutions forward, I think we need to learn from good old Arnold Schwarzenegger, and I'll just make sure this will play here. Let's have a listen. This is a clip from Arnie on a radio show over in the UK where he discusses, and I've heard this story before, of how he made his money. And there's a very interesting takeaway from this. Okay, audio.
And, investing wisely, and then have certain things that they're passionate about. Like, for instance, before I got into acting, I became very passionate about real estate.
Right.
In America.
These days, you'd start a course in it. Passionate about real estate. Okay, real estate. This is one of the things that people invest in to hedge against inflation.
There was a time in the 70s where the interest rates were high, and you could not lose. The inflation rate was also high. So you buy a building for $1 million. The next year it was $1.3 million.
Wow.
The next year it was $1.6 million. So you put $200,000 down, you can double your money in no time, right? So this was the idea. So I became a millionaire. I remember before I was 28 years old, I was already a millionaire within real estate.
So, I mean, one of the ways he made his money when he went over there, he was, doing the bodybuilding, he was competing, he was doing bricklaying. Arnold and a mate, they'd go out to clients, and, they'd do the good German, bad German act, and they'd do bricklaying. People pay him up front, they just go there and do it. I mean, look at it. He was a millionaire by 28 years old, everyone. He'd built it up in property during these inflationary periods. So even if we're hearing about inflation, we're worrying about inflation, there are opportunities that can arise out of this.
Before I really got into the show business, before I did movies, and the advantage of that was that I didn't have to take stupid roles just to pay for the rent.
So that's the really interesting takeaway. He had the FU money, guys. He could choose not to work for particular roles, not to work for clients you don't have to. That's taken, for me, it's taken some time to learn that. To not have to work for the clients you don't have to. You don't have to put up with the BS. I was talking to a contractor the other day going, I'm at a point now where I don't want to work for the bastards anymore. I can't put up with them.
So what they wanted me to do in the beginning was to play villains and to play, Nazi officers, right, and to play bouncers and all this crazy stuff. But I wanted to build myself up to become a leading man. And the only way I was able to do that was by having a clear vision and to be financially independent, so I didn't have to take the stupid roles in the first place.
And that's the lesson right there that I think we can take from Arnold. Well, I mean, he made his money during property, so there's opportunities even with high inflation, but also having that, FU money so you don't take the dodgy roles. So what are the solutions from this? One, property, guys. Should we take the Arnold Schwarzenegger approach and jump into property, or as I like to call it, Australian gold? Or do we actually invest in precious metals, in gold? Good old gold and silver. Thousands of years of history to them, and people will still see them as money and of value until the end of time. I don't care what anyone says. What about uranium? Mineral of the future? Or would you look at shares, investing in companies that can, that won't be affected by rising inflation? Maybe they've got a corner of a market. Maybe they can control it. Maybe these software companies that are indispensable and they can set the price for their goods. Maybe they don't have much debt, so it won't affect them that much. So there's opportunities. Or what about crypto, everyone? Do you think that's going to be the big one? But it's so volatile. I'm checking it out right now. Hang on. We'll have a look. I'm watching it now as I'm recording this. It's 33,000 for Bitcoin. So we'll have to see if she can break under 30,000. I think there's a whole lot of people have got buy orders sitting right there. But it's a volatile one. What do you think? So, there we go, guys. Some solutions, a lesson from Arnold Schwarzenegger, and a warning from Deutsche Bank that we could be going back to the 70s. What do you reckon? And what's your favorite Schwarzenegger movie? As always, guys, thanks for watching. Please like, share, subscribe to the channel. Let me know your thoughts and opinions on this one in the comments down below. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy a merch from Heise Says, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I'll see you next time. Bye for now.